Well, good afternoon, everybody, and welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by an author of a book that I have recommended more than any other real estate book that I can think of. It's written by James Randel, Confessions of a Real Estate Entrepreneur. And this book actually came out in 2008, if I'm not mistaken. So I really wanted to get a chance to talk with Jim and see what's changed in the real estate investment market in the last 17 years or so. But before we get to that, Jim, thanks so much for agreeing to jump on this call with me.
My pleasure. Nice to be here.
So you wrote that book in 2008 or when it was published. So maybe you wrote it a little bit before. And I know a lot in the world has changed, but have you noticed any significant changes in real estate investing over the time since you wrote that book?
So, real estate, unlike maybe any other asset class, has some fundamentals that are immutable, if you will. And yes, of course, there are changes. But when you think about the fundamental principles of real estate investing, development, they don't change all that much. I think, as you know, Chad, from my book, and thank you for the number of recommendations you've given me, I'm an added value guy. I believe that the way to achieve great wealth in real estate is to always look for adding value. I'm not a guy who would look at a building with, I'll make it up, $100,000 net operating income and say, okay, well, I'll pay 5 cap on that. So, that's just not how I see the world. I see the world that look at a building or a piece of land. What can I do to add value to that others may not see? And then try to obtain the property and execute. So your question, I'm circling back to your question, that hasn't changed really. In my investing in the last 17, 18 years, I continue to look for added value opportunities. They may be in different places than they were 17 years ago, but the principle still holds.
Have you had any scenarios where you thought that there was an opportunity to add value and then it just didn't come out exactly as you hoped that it would?
Yeah, many times. The answer clearly is yes. And maybe before we break on your podcast, I'll tell you about a new book I'm writing. After every 17 years, Chad, I get the impulse to write a book. It's about the mistakes I made, because there are two types of mistakes. One is just an error in judgment, a one-off. You thought something was going to happen and it didn't. And the other is a mistake that's due to some structural personal issue. That part of this new book I'm writing is, why did I make a mistake more than once? A one-off, I understand. Okay, I made a bad judgment. I guessed wrong. But when you make a mistake that's attributable to some part of your character, personality, then that's different, because that you can change once you really are in touch with and understand it. So yes, there are many times I thought I could add value, and I just misinterpreted the way the market was going. I overestimated some part of the deal. But no question about it. I still, however, maintain that the way to achieve great wealth in real estate is by adding value.
I'm super excited to hear that you're writing a follow-up book. You'll have a very avid reader in me on that. And the reason I asked that first is because I wanted to, I suppose, frame the next question on how you find opportunities to add value by first saying it's not, I suppose, a guaranteed way. You can't just look at a property and say, okay, well, I know I can do this and it'll work out. There's still challenges and there's still obstacles that have to be met. But as you said, if you stick with it, and if there's really no other vehicle that can get somebody that level of wealth. But how do you sense opportunities? Is it looking for something in specific? Like you perhaps look for And just using an example, perhaps an apartment building that doesn't have laundry. So someone might say, okay, well, I just look for buildings that don't have laundry and I go and add that and then I increase the NOI. And that's just one specific example. But do you have any cookie cutter formula that you say, well, here's a property that I know is missing something, I can just add it? Or is it case by case? Is it market by market? How do you actually find that value add opportunity?
Yeah, not easy. I don't have any one criteria like, no laundry, buy that and then put in laundry and up the rents. So for me, it's just a large network of people who know what I do. I've been doing it for a long time, both in the Northeast and in Southern Florida. Um, but, sometimes I'm just wrong. Um, I'll give you an example that I wrote about in this new book where a lot of people were wrong. I bought a building in Miami, Chad, a 250,000 square foot shopping center that, was poorly leased, aesthetically unpleasing. Parking was not lined properly. A lot of mistakes that I thought I could correct. And I did correct them. And we did a much better job leasing. But the mistake I made, I took a loan with a yield maintenance clause. Now, I don't know if your listeners know what that is, but that's a clause that basically says, hey, if you pay off your mortgage sooner than the expiration date, and rates have dropped, you owe us a fee. It's called a break fee. So I did everything right in rehabilitating the center, but the mortgage I took had a yield maintenance clause. Well, I sold the center, I put it on the market, went to contract, got a good price. I called the lender because I was selling before the expiration date on the loan, which meant that there would be a break fee. And this was in the fall of 2019, Chad. And the lender said, you know what? Interest rates haven't changed much from the time you took the loan out. So your break fee is going to be virtually zero. Well, between that conversation and the closing date, which was in March of 2020, COVID happened. And if you remember, the government lowered interest rates dramatically to deal with COVID. And so when I came to the closing table and asked my lender, okay, well, what's my break fee? It was virtually zero 3 months ago, 4 months ago. The lender said it's $2.2 million. So I did I did everything right in terms of adding value, but did I see COVID coming? No. Did anybody see it coming? No. And when the interest rates went to zero, I had a $2.2 million expense at closing that I had no idea was coming. So sometimes you think you're going to do everything right and even do everything right. And then, you may have heard the expression of black swan. Something comes out of complete left field that you're not prepared for, didn't expect, and it takes your breath away.
So you've been able to avoid a black swan event like that from crushing you personally and perhaps forcing another investor into bankruptcy. Maybe that was all that the investor had was that $2.2 million and a project like that just put them underwater.
Yeah.
Is that just a function of you being in the game long enough and having successes on other properties that make that one less painful? Or what happens in a scenario? Because a black swan, by its very nature, we can't predict it happening. What about that investor that is scared of that for that exact same reason that's preventing him from making a decision because he doesn't want to do everything right and still lose?
Well, you obviously do the best analysis you can, but not put yourself in a deal that is so large that if everything did go wrong, you would be wiped out. And I think I was referencing a book called The Psychology of Money by an author named Charles Housel. And he says, it's okay to take risk, but just don't take any risks that could wipe you out. And he uses an example. It's kind of a clever example. He says, look, if somebody was going to play Russian roulette and they say to themselves, "Oh man, I got a 1 in 6 chance of problems," he would say, "Yeah, but if that problem happens, you're more than wiped out. You're off the earth." He try That's his analysis. Just don't do anything that, if things go wrong, can wipe you out. I still, fortunately, in the example I gave you, Chad, we had enough room to absorb the $2.2 million break fee. That was, I mean, I just have to emphasize, we never saw it coming because we never saw COVID coming. We never saw the government's reaction to COVID, but we had enough room in the deal to absorb it, and we still were okay. Other people with, less margin could have been hurt very badly.
Well, it just goes to show you too that you do need to make some assumptions, but you do need to take a bit of risk, but you still need to do sound business, because for you to go and execute your plan and still have enough margin in there that a $2.2 million hit still made sense with the deal. That's a testament to just how important it is to make sure that you get things as right as you can. How you mentioned you've got a lot of connections, a lot of people that you just know that know what you're looking for. What how does someone else go and create that? Because I think that that's a challenge that a lot of new investors have, and maybe it is just something that they have to learn how to do, and they have to build those relationships over time. But a lot of people want to see more deals, and they perhaps find the ones that are being publicly marketed. They find the stuff that everyone else has already passed over. How do you find deals? Do you look at properties that'd be on a public platform, or is it more of a relationship based business where you're trying to see things before they hit the active market?
Yeah, so it's all of the above, Chad. I do everything. I look at what's online, what's available publicly for sale. Some, I mean, I A very large property that I did. I just was driving by it and I saw it and it looked like, wow, that's not a very well maintained property. So, it's also time, Chad. You have dark hair, I have white hair, and that tells you something about how many years I've been doing this. And, it's just time. People over time learn, hey, this guy's an added value investor. If I have an added value deal that may scare other people, I'm going to bring it to him and or her. And I just been doing it a long time, and I have a reputation of being a closer. I'm not a guy who's a tire kicker, who will waste a broker's time or an owner's time or a lawyer's time. I try to, if it's a real deal, I try to be a good closer, always keep to my commitments. So people get the idea. Eventually, I don't know your market, Chad, but in my world, which is Connecticut and the New England area, and then to a much lesser degree, Miami, people sooner or later learn who's a good buyer and what they're looking for.
When you get presented an opportunity, over the experience that you've had, you're probably quick to do almost some mental math and determine if it's an opportunity or not. Do you still go through an exercise of basic back of the envelope math? And then the second part to that is, assuming that it hits those criteria, what does your due diligence process look like?
So I try to move very quickly because I want to keep people happy. If somebody brings me a deal, I want to move quickly. Sometimes you say no, you say it's not for me, but I want to give quick response. So I think people underestimate on due diligence. When you go to contract or purchase sale agreement and you build yourself even a short, call it a 20 or 30-day due diligence period, which is very customary, you can do a whole heck of a lot of homework in that 20 to 30 days. So if somebody brings me an added value opportunity, yes, I make some quick mental math on the back of an envelope. I then try to go to contract with a sincere belief that this is a deal I want to do. But I use due diligence to do a lot of homework. And if I don't feel right about it, I pull out under the due diligence clause. But I go to contract quickly as I can.
There's some buyers that get a bad reputation for retrading. So they'll put a building under contract, and then at the 11th hour, when the due diligence is up, they'll ask for a sizable haircut to address some of the issues. What's your general take on that?
Wow, it's like you read my next book because I have a whole chapter on retraining. I think we have to disclose that you haven't seen it yet. So let me tell you a retrading story. How I learned about retrading, and it's a painful story, and I wrote about it in this new book. So we had a building for sale, Chad, in Miami. We thought it was worth 22 to 24 million. We got an offer at 20 million, an all cash buyer. We did our homework. It was a guy who we knew was very, very wealthy. We knew he wouldn't have a problem getting the capital. And he had in the contract a 45-day due diligence period. And we felt very good. We knew he was doing his appropriate inspections. We had heard nothing negative. And on the 44th day of the due diligence period, this is one of the first deals in Miami, and I should explain that because I wasn't as familiar with retrading as it's not as common, at least at the time it wasn't. So on the 44th day of the due diligence period, his attorney called me and said, Randel, Mr. Buyer is willing to go forward, but he wants price reduction from 22 million to 20 million. So I said to myself, oh, he's trying to chip $1 million off the price. I said, I'll tell you what, I'll agree to 21 million. He says, let me call the buyer. He called me 10 minutes later, said, deal's off. I said, what do you mean deal's off? He said, the guy said it was 20 million. You said no, you rejected his offer, deal's off. So I later learned that that was part of his modus operandi. He was a retrader. I should have known that. And here's the bad news, Chad. It was about the time this was a retail building that everybody believed that, Amazon was going to take over the world and brick and mortar retail was going to go the way of the dinosaur. And so I eventually sold the building, but at 15 million, 1.5. So, yeah, that's right. That's how I feel too. So since I learned about retraders the hard way, but now, this is 217, 218. I'm much more savvy to that. And, shame on me. I should have done my homework and I should have learned that this guy was a retrader. And when his attorney said 20, I should have said done. The attorney said he'll go hard today because he had 2 million or 22, not 2,200,000, 10% deposit. He said, he'll go hard today, but at 20 million, are you in or out? And I said, no, how about 21? And that's when I lost the deal. So I learned a very, very hard way about retrading. Painful to tell you about it, Chad, just to talk about it.
Yeah, oh, I bet. Well, and that's probably the story of being a real estate entrepreneur for the amount of time that you've done it is you've got a lot of great stories, but there's also the stories that hurt to tell. So yeah, I can appreciate that.
So I'm just going to comment on that, Chad. So I grew up, I don't know where you're located. I grew up in a small town in Ohio called Sandusky, Ohio. And Sandusky has a big amusement park. And it's known as the sort of roller coaster capital of the Midwest. So when I used to do a lot of speaking about entrepreneuring, I don't have as much time to do that anymore. But I said, as a kid, I spent my summers riding roller coasters, and little did I know it was great preparation for the life of an entrepreneur, up and down and sideways and upside down. And sometimes you feel sick. So, yeah, it's the life of an entrepreneur, Chad. But I also maintain if that's in your DNA, you kind of don't have too much choice.
Well, just like the roller coaster rider, there's some thrill seekers that they might get on a roller coaster and get off and say, I'm not doing that again. And then next thing you know, it's pulling them towards it and they just can't resist. So I think we share a lot in common with the thrill seekers of roller coasters.
And some people love it. Some people like their up and down. I'm somewhere in between, Chad.
When I know that you've got a time here.
I do.
When is the next book coming out? First of all, that's what I'd love to hear because I want to get a copy of that.
You will get a preview copy for sure. The book is called Confessions of a Semi-Successful Entrepreneur because I want to talk about so many entrepreneurs write about all their success stories. You heard a little bit today that I've had a few setbacks on this roller coaster ride we're both on. And so when I say semi-successful, yes, I've had some nice paydays, but I've also had some setbacks. And it's about both. And it's about why. Why did I have the setbacks? Did I make a mistake? Yes, on the retrade, I did make a mistake. I should have been prepared for the retrade and just said yes to the 20 million. Chad, I talk a lot about qualities, people who are very uber successful, what entrepreneurs, what qualities they have. I talk a lot about deals that weren't necessarily real estate deals, but other startups I was involved with. So I hope you'll like it. I'll make sure you get one. And then maybe if you like it, you'll recommend it the way you did my first book.
Yeah, it's still a book that that 17 years later, I think it is still quite applicable for anybody because you what I've really admired about the book is that a lot of real estate books focus on technical aspects of it, and I don't think that tells I don't think that tells a lot. Whereas yours, you go into a ton of stories, you talk about actual deals, you talk about the ups and downs, and I think hearing from somebody that's actually doing it, and I think that there's a lot of fake gurus out there as well that think that they know what they're doing, but they haven't even done anything themselves. So your book is incredibly well written, and it tells how to do deals. It's also showing you how showing people how you've done deals. So I think your follow-up book is well needed in the space of the real estate market where people just legitimately want to hear stories like you're telling. So I find it very fascinating.
Well, thank you very much. I'm very, very appreciative to have been on your show. And sorry for the bad connection, but hopefully you can edit that. And it was a pleasure to chat with you.
Yeah, absolutely. I really do thank you for taking the time to do this. And if the connection issues was on my end, I apologize for that as well. But that was a fantastic conversation. I thoroughly enjoyed it and really look forward to to your next book too.
Thank you, Chad. Be well now.
You as well. Thanks again, Jim.
Take care.